The debt ceiling crisis, how do you see it potentially impacting the dollar? Could it make it so that the dollar is no longer the world's reserve currency?
Well, I think there's risks to not being able to pay your bills, but we have to put in context that the U.S. government will collect $4.5 trillion this year, and we'll have $700 billion of interest costs. So even if we do cross the X date, we believe that the Treasury will prioritize those interest payments to make sure that bondholders will continue to get paid. That being said, that means that there will be less money for other uses of the government, and the government would have to prioritize which spending programs that they would want to put themselves into. And that means that you'd have about $1 trillion of government spending turning off, and it would lead to a contraction of somewhere between 5 to 7% of next quarter's GDP. So you could have a really big economic event, you could have a really big political event, and you can have a crisis of confidence in our elected officials if we do not get the debt ceiling up in time. But that also needs to be balanced with the fiscal deterioration that's happening in the U.S. Yesterday, we received the April tax revenues, and what we found is that the debt servicing cost of the U.S. government is exploding. It is now at the highest level since August of 1999. And Frank, this is the first time in 40 years the U.S. government has an increasing debt servicing cost. So we have to balance the need with making sure we don't default, but being able to get our fiscal trajectory in better shape. And I think that's going to be the challenge for the two policymakers, President Biden and House Speaker Kevin McCarthy, when they sit in that room at 4 p.m. today.
All right, so a multifaceted issue. You're also bringing up debt service, Janet Yellen flagging the dollar status. So a lot of things at play here. Just across the board, the U.S. defaulting, a bad idea, just overall.
Yeah, no doubt about it.
All right,
Nor do I think that we are going to default, even if we don't get the debt ceiling up, because we have enough cash flow to continue to pay those interest.
So you're kind of answering one of my questions right now. So we have this big meeting today at the White House. We have congressional leaders and the president meeting in the Oval Office, some very serious high-level talks here. What do you see as the most likely outcome from this meeting?
Well, if they don't yell at each other, we'll call that a victory. That's first. Second is that what we're trying to get to is a point where the staffs of the White House and the House can start to meet and begin to put together a real deal. Now, we only have 3 weeks to act. That gives you limited time. But what you want to see is a broad agreement develop over the next 3 weeks where they say this is what the spending levels are going to be. Are we going to include energy permitting reform? How are we going to deal with work requirements on some of the transfer programs now that COVID is starting to end? Those are the types of agreements that you want to start to see. Unfortunately, I don't think we'll be at that level today. If we did, that would be a very big win if you get some sort of broad agreement. But just getting to that next step, allowing the work to be done at the staff level, would be a huge victory for the markets, because it would be telling us that policymakers are trying to figure out how to raise the debt ceiling, not whether to raise the debt ceiling. And that's a very important distinction, Frank.
All right, Dan,
that would set the stage in motion for some sort of deal.
I want to jump in. I want you to explain something to me. So you're saying the markets are repricing the higher risk of a default. Right now, 1-month Treasuries at 5.5% yield. So that's obviously elevated. At the same time, you're saying once the deal is reached, there's even more risk for the markets after we get a deal, if and when we get a deal. So explain that. Once this crisis is resolved, why is there more risk in the markets?
Yeah, I would argue that you're seeing risk reprice in 3 areas. The first is defensive stocks, the second is gold, and the third is treasuries that you just referenced. As we get closer to the debt ceiling, though, Janet Yellen will be providing significant liquidity by spending down the cash that she has. So she's taking money that's not in the banking sector and injecting that into the banking sector. That's going to help cushion financial markets as we have to stomach this political debate, which will not be pretty to watch. Once we get the debt ceiling up, though, we have a number of headwinds in front of us. How much austerity is going to be attached to this bill? Are we going to cut government spending, and when? Second is that liquidity that Janet Yellen is providing will start to come out of the market, because she can go right to the debt markets and raise that debt. That money's coming out of bank reserves. You're actually removing liquidity. So if you go back to 2011, the last time we had a debate like this, what you actually saw was that we had a larger decline in the S&P 500 after President Obama and Speaker Boehner came to the deal. And there's a risk that could happen this time around, which is extremely counterintuitive, but something investors need to be aware of.